Hello, this is Brian Rezny, President of Rezny Wealth Management and host of the Rezny Wealth Report. We've got a great show for you this Sunday morning. Of course, we're going to be taking a lot of calls and questions. You can always send an email question to Brian Rezny at reznywealth.com. And of course, make sure you do visit our website, reznywealth.com. We have offices throughout Florida, specifically here in Naples and in Fort Myers, and we invite you to visit our website and schedule a consultation to review your portfolio. You know, I want to talk about investing today and really what causes problems for the average investor in the portfolio. And too often it's investor behavior that really matters when it comes to investing. And you know, we've all seen markets go up and down. We've seen the bond market go up and down. You hear about gold and real estate and oil going up and down. But at the end of the day, a sound investment strategy, in our opinion, is going to really help an investor achieve their long-term goals. The problem is how emotional investment decisions really impact and hurt your retirement and your portfolio. And I see this all the time. I've been managing money for almost 30 years. Investor behavior really does matter. And I'm going to talk about some specific examples today on today's program so you can really understand why these emotions need to be avoided, and you really need to stick to your game plan and your investment strategy in order to have the opportunity to grow your income and grow your retirement portfolio. How did your portfolio hold up during the last market sell-off? Did you panic? Did you sell out after the last drop or the one before that? I can tell you I've been doing a radio show and a TV show for years. I received dozens of phone calls almost on every show from investors who panicked and said, Brian, I did exactly what you tried to educate us not to do. I sold at the bottom, only to see the market go back to a new high. The bottom line is this. Emotions, again, are going to affect your returns, and they're going to make you do things that you should not do. The other problem often is your broker or so-called advisor. Most investors falsely believe that their investment firm is actually managing their money. Well, there are real investment management firms. Those would be registered investment advisory firms in an advisory account. But most Wall Street firms, annuity salespeople, brokers, so-called advisors really aren't managing your money at all. They're really acting as a broker or salesperson. So make sure you do understand, do you have a broker or salesperson, or do you have a real money management firm, a fee-only registered investment advisory firm? Most investors are constantly changing their investment portfolios based upon market movements, not investment strategy. Emotions and news will hurt your retirement. Let me explain. You might have a portfolio with 10 different investments in it. 3 of those investments are not doing a lot currently or for the last 6 months. So you decide, I'm going to sell those investments and pile the money into the other 7 investments that have done well, only to find out you basically sold the 3 that you should have kept because those recoup some of those losses and actually outperform the other 7 investments. Investors often, again, will base investment decisions on emotion, news, and short-term performance, which ultimately does hurt your investment portfolio returns. I've seen this time and time again. Brexit, Ebola, government shutdowns, the list goes on and on. If you look back at 2015, there was talk about an interest rate increase. The market sold off 8%. What did you do? Did you sell? Or did you hold your positions properly and let the market recoup? You know, we're in 2016 now. The markets, generally speaking, if you're invested correctly, you're probably a pretty happy investor. If you're not invested properly, you're not happy. Or if you made an emotional decision to sell when the market had turbulence. Again, investment strategy or emotion, and is your broker really managing your money? A real investor story. This is a true story from an actual client of Rezny Wealth Management. The facts after the sell-off back in July of 2015 based upon interest rates. My firm received a call from one of our clients, a shorter-term client, only a client about 6 to 9 months. Called, very panicked. He said, if you've noticed the markets are selling off, and I said, yeah, it's a little concerned about interest rates, garden variety sell-off in our opinion. The client said to me, well, I had a premonition. I said, a premonition? He goes, yes, I had a premonition. Things are going to get really bad, and I want you to liquidate my portfolio and put it in cash until things get better. I told him, you're making a big mistake, and you're not allowing us to do our job. Well, that client had a portfolio, let's say, close to $1 million. When we sold, he was down about 7 or 8% with that market sell-off back in July of 2015. He sold at the bottom of the market only to see the market recoup and go to new high ground. Of course, we no longer kept that person as a client because we explained to that person, you're making an emotional decision and you're going to hurt us having the ability to actually manage your money. You should really do something else and find a new advisor. That client, of course, cannot be a happy person now because he locked himself into something close to a $70,000 to $80,000 permanent loss because he sold based upon emotion or a premonition, as he called it. Again, is your money being managed by your broker or so-called advisor? Are you being emotional? And how much does that cost you? Do you jump from investment firm to investment firm or investment to investment every time things drop 3 or 4 or 5%? Big mistake for too many investors. If you wish to make money, you're never going to be able to avoid short-term up and down movements. Let me explain. The stock market will go up and down short-term. It happens every year. Over longer periods of time, the equity markets have done quite well. The bond market, people who think bonds are safe, they also go up and down, but have done quite well the last 10 years. Probably not to be repeated because, again, interest rates are low and they're not going to make capital appreciation anymore because they can't go from 10% down to 1.5% like we see today. So the bottom line, all investments have risk. They all do short-term volatility, whether it's oil, real estate, gold. You are not immune from short-term volatility. The key is, do you have a long-term investment plan and strategy, and do you follow it? Managing risk is important, though. At Rezny Wealth Management, I'm proud to say we manage our clients' risk. We're not worried about day-to-day fluctuations, but we are very concerned about recession risk. So we not only diversify our portfolios properly, but we also look at recessions and recession risk possibilities. We look at these daily. While we don't make short-term knee-jerk reactions to our client portfolios, what we do is we make sure we're watching out for a real recession, like in 2000 or 2008, where the markets dropped 50%. Should we be selling equities because the economy is slowing and we see real signs of recession based upon hard research and not emotions? You should be concerned about diversification and you should be concerned about recession risk. Those are two big ones in your portfolio. Over the last 30 years, Delbar is this independent company that does investment study returns. They look at the last 30 years or so, and they look at the crash of, if you look at 87, 2000 recession, 2008 recession, and subsequent markets ups and downs. Bottom line is this, the average investor makes about 4% return at the same time the S&P was making over 10% a year. Why is that? Because they're using emotions and chasing investments back and forth. Just because you have some investments or your portfolio short term is not quite making money is not a reason to change. Now, if your investment strategy dictates you should change, great. But don't do it because of your gut, emotions, or a premonition, because those are all big mistakes and reasons not to make changes to your portfolio. The S&P lost 37% plus in 2008. Better than the average equity investor who lost 41%. Again, study from Delbar. You, the investor, have made horrific mistakes with your portfolio. Your broker probably hasn't done much better, but again, remember, your broker is really not in charge of managing your money unless you are in an advisory account in a managed money agreement under a registered investment advisory agreement or firm. Remember, don't falsely believe your advisor because he wears a suit is actually managing your money, because they may not be, and that ultimately also might harm your portfolio. The average asset allocation fund, in contrast, these are funds that are well diversified, lost 30%. So ask yourself this: how did you do in 2008? How are you going to do in the next market recession? It could be next year, it could be in the next 10 years. But at the end of the day, are you managing the risk in your portfolio, or is your portfolio managing you based upon your emotions and your attitudes towards short-term volatility? I think too often, too many investors are making poor investment decisions because the advice they're receiving is not advice at all. Lesson: follow an investment strategy which always includes risk management. Again, what's your investment strategy, and does it include risk management? Yes, should you sell during a recession or at the approach of a recession or slowing economy? We firmly believe you should. Currently, we're not seeing those big signs of recession, but at the end of the day, do you have risk management, and are you doing the right things with your money? And remember, don't let emotions ruin your portfolio or retirement. Too often investors, again, emotions supersede a strategy. That's a big mistake. Learn from others' mistakes. Learn from the average investor who doesn't make money with their money or makes far less than the average market returns because they're using their gut reactions or emotions to make decisions. Go to ReznyWealth.com, visit our website, learn more about investing, sign up for free instant email alerts about the economy, recessions, investment strategy, educate yourself. Better yet, call my firm for a consultation. There is a difference in investment advisory firms, and we do invite you to experience it. I'm going to take a short break. I'll be right back with questions after this. Hello, this is Brian Rezny. If your goals are to increase your retirement income and retire without stress, go to my website and download our groundbreaking free report. This free report covers the investment and retirement pitfalls that are often overlooked even by the smartest investor. If you're concerned about outliving your money during retirement, or maybe you want to make sure you're not leaving money on the table, this free report is for you. Know the facts. Your retirement depends on it. Go to my website, ReznyWealth.com, and download your free report right now. And we are back. It's Brian Rezny, host of the Rezny Wealth Report. Of course, we're going to take some question and answers. If you have questions about your portfolio and investment or your retirement or any financial questions, please send those to Brian Rezny at ReznyWealth.com. We want to make sure we get all of your questions answered. And if you're really concerned about the advice you're receiving, if you feel your returns are lacking, if you feel your advisor is just not up to the standards you demand for your portfolio, call my firm for a consultation. We do deal with larger portfolios. Call us, schedule a consultation. Let's sit down, let's review your portfolio. It's time you get back on track. It's time you get the advice you need so that you can keep a successful retirement in track. Jerry from Cape Coral, Florida. What do you think about investing in oil and how? Great question, Jerry. I've talked about oil a lot over the last year and a half simply because we receive a lot of questions about oil because we've seen nothing but oil go down in value. And ultimately, if you go back about a year and a half or so ago, oil prices were about $100, $110 per barrel. And over that next 6 to 12 month time frame, we've seen oil prices drop as low as the high 20s. So from about 100 down to about the high 20s. I've repeatedly discussed oil and supply and demand in our economy. The bottom line is this with oil: because of technology and fracking in our economy and our country, which generally speaking is not used a lot in other countries, fracking anyway, that technology, we have an overabundance of oil. So oil prices have come down. Our economy and the economies of the world are not growing fast enough to use up all that extra supply. So this is my opinion and what I see oil. Oil will probably stay between $40 and $50 a barrel for the foreseeable future. until in time the economies are growing sufficiently fast enough to start using up some of the supply. But ultimately, I don't see oil prices going back to 100 anytime in any of the next 2 or 3 or 4 years, unless there's some kind of crazy boom economy where the world economies are all growing at 3 or 4%, which I do not expect. So expect lower oil prices. If you're going to invest in oil, my personal opinion is be cautious as a sector. Oil, unless oil prices go up, oil companies won't make more money. Remember, earnings drive equity prices potentially higher. And if oil prices don't go up, oil companies won't make a lot more money. I would not be a big overall investor in oil or playing that bet. But if you are going to invest in oil, in my opinion, the best way to do it is be diversified. Utilize ETFs, exchange traded funds, and you can take a look at the SPDR XLE. It's an ETF that owns a broad basket of large and mid-cap stocks in the oil industries, whether they're big integrated oil companies like ExxonMobil, or they're basically more mid-sized like Schlumberger and service companies. I think that's a great opportunity to look at because, again, you have built-in diversification, and you don't have to worry about doing daily research on individual stocks. So take a look at the XLE. Rob from Naples, Florida. What opportunities exist for income investors and interest rates? Rob, a lot of questions over the last 3 or 4 years about interest rates I have received, and also the question about what can an investor who's looking for income do? Bottom line is this. Interest rates are probably going to stay low or lower for an extended period of time because, again, the economies of the world are not growing sufficiently fast, and generally speaking, inflation is really low and not really increasing at any dramatic rate. The Federal Reserve will probably keep rates low. If they do start raising rates, it's going to be very, very slow and methodical. So if you're going to buy bonds, plan on making probably less than 2% a year on bonds. CDs are going to probably pay less than 1%. So what you really want to look at as an investor is called total return. You need to look at investments that can grow in value and also produce income. Total return is the growth of that asset, and the income in combination is total return. That is your best opportunity to try and get income and growth. And remember, you can sell some of that growth off each year to generate the income stream you need. So your money to live on as a retiree does not need to come just from an income or a dividend. It could come from growth or a combination of the two. In my opinion, over the next decade or two, retirees who do not look at total return, growth, and income are going to suffer the consequences of substantially lower returns on their portfolio and probably drawdowns in capital as they have to spend principal in order to keep up with their lifestyle and income needs. Dean from Boca Raton, Florida. You discuss ETFs, which are exchange-traded funds, folks, and their benefits all the time, but I asked my advisor, why doesn't he utilize them? And he gave me the answer, they are risky. Can you explain? Dean, the bottom line is this. Your advisor probably doesn't really understand ETFs, and he's probably not a real advisor. He's probably a stockbroker in disguise that really wants to sell you a higher commission, higher fee structure investment. ETFs, exchange-traded funds, are just a basket of investments, whether those are in bonds or gold or oil or whatever. And ETFs are no more risky than any other prevailing asset class that is similar. So if you buy a mutual fund that owns large cap growth stocks and you buy an ETF, let's say the S&P 500, they would have similar risks if they own similar assets. The difference is your mutual fund's going to have much higher expenses, often by 10 times, versus an ETF. They might have a cost structure of 10 basis points a year or 0.1%. That average mutual fund might have an average cost of 1.25% a year. So your broker will like mutual funds or other investment categories or asset styles differently than ETFs, but he doesn't want to necessarily put you in an ETF because he can't make a big lavish commission. I can tell you, if you are an investor and mutual funds and variable annuities or annuities in general or non-traded REITs are showing up in your portfolio, there's a good likelihood you've got a broker or a salesperson selling you higher commission expense products, which ultimately take away from your return, because remember, expenses do matter. Tom from Naples, Florida. My wife and I were pitched an equity index annuity after a dinner seminar with a 10% bonus. What do you think? We are 73. Tom, first off, equity index annuity is basically an annuity that has a wrapper around a specific index to calculate returns, to keep it simple. Annuities in nature are extremely expensive investments. While this salesperson at the dinner seminar may have told you there's no expenses with annuities, equity index annuities have a lot of expenses. Let me explain. There's a cost structure for that bonus. He's talking about a free 10% bonus. When you buy an equity index annuity, if you take the bonus, there is often an annual charge to get that bonus. What, you say? There's a charge annual if you accept the 10% bonus? Yes. Often as high as 1.15% a year, maybe more, maybe a little bit less. But at the end of the day, there's no free money with any annuity. You also lock your money up in these annuities, often for periods as high as 22 years, as high as 22% to get all of your money. You pay higher taxes when you take the money out. Realistically, because of the expenses and the way these equity index annuities are structured, you'll be lucky over a 10-year period if you average a 1 to 2% return on your money. And that 10% bonus isn't on your real money, it's on what I call the fake hypothetical pot of money. The only way you get that is you have to turn it on for an income stream. Now, you said you're 73. Let me ask you a question. If you're 73 years old, do you want to insanely lock your money up with a 10 or 12 or 14% surrender penalty for the next 10, 12, or 14 years? I would hope you would not. The problem with equity index annuities in general is they're sold by insurance agents who have an insurance license. These things are loosely regulated, if at all, in my opinion. And they're sold to unsuspecting seniors most often who don't read the fine print. Avoid equity index annuities. Go to my website if you want to learn more about dangers of annuities. Go to ReznyWealth.com and for free, download my groundbreaking report, Why Annuities Are Dangerous to Your Wealth and Retirement. Ken from Fort Myers, Florida. What do you look for signs of recession? Ken, that's a great question. The big risk that investors need to realize is recessions. That's when the overall U.S. economy or the global economies have a substantial retraction of gross domestic product or GDP growth. It's basically what I call a pause that refreshes. To give you a good example, you're driving down Alligator Alley, you're doing 80 miles an hour, you're coming up on somebody fast in the fast lane, you have to tap on your brake, slow down, and move around to the outside lane to avoid that person. So you're making an adjustment. A recession is kind of the same kind of pause. But in recessions, often the equity markets will drop 35 to 50%. That's historically been the case. The typical contraction of GDP is usually between 2 and 4%. The signs you want to look at, there are many signs that we look at as a firm and a lot of daily research, but I'll give you 2 as an investor that you can kind of watch on a daily, weekly, monthly basis. And those would be housing starts. Remember, housing is a big key driver to the U.S. economy. Housing right now is in a decent, slow uptrend, meaning there's houses being built and the uptrend looks good. When you start to see housing starts roll over or stagnate, that could be the first sign of recession. The other one that's easy to look at is unemployment. Unemployment currently is good. It's around 5.5, 5.6%. If you start seeing unemployment start to go up, coupled with housing starts going down, that usually is a very strong sign. You probably want to look at recession. You probably want to reduce equity exposure in your portfolio because we have a potential for a big drop. I can tell you currently, both recession and housing look decent, so we currently don't see signs of recession. That may change in 3 or 6 months or 6 years, so you need to look at this stuff daily and do your daily research. Sal from Naples, Florida. My wife and I are 78. We have $1.9 million portfolio. We are mostly in variable annuities and non-traded REITs. None have done well, especially the annuities. Our advisor says, stay the course. What are your thoughts? Sal, I would tell you to fire your advisor because your advisor is no more advisor than my pet lab, Martini. Your advisor probably wears a nice suit, but he's really a broker. A, You're being sold variable annuities and you're being sold non-traded REITs. These are two investments on my hit list you want to avoid. There's no reason to buy a variable annuity unless you want to insanely lock your money up with high expenses and pay higher taxes when you take the money out. And there's no reason to buy a non-traded real estate investment trust because again, high incredible fees, and there's no reason to insanely lock your money. You can look at other investments that have low cost and liquidity. Sal, your money has not probably done well because the annuities have high expenses, and that REIT that you bought probably has high expenses coupled to that. You, as an investor, have to educate yourself. Are you working with a fee-only fiduciary advisor, which I'll guarantee you, if you were sold those two products, Sal, you are not. You're working with a brokerage firm, and when you're working with a brokerage firm, you're working what's called suitability. Go to my website, reznywealth.com, learn more about fiduciary and suitability and how to protect your money from a fake advisor who wears a nice suit but actually doesn't work in your best interest. Go to reznywealth.com and download our free report, Fiduciary versus Suitability. Read it twice, educate yourself, protect your retirement. Terry from Punta Gorda, Florida. You have been spot on in your assessment about staying the course. No recession all year, thank you. What is your outlook for the upcoming election? Terry, I have received, I don't even know, probably hundreds and hundreds of questions about the upcoming election. My gut reaction is this. I hope a Republican gets in. I look at the Democratic side, and they have the same no-growth policies that our current administration has. So if a Democrat gets in, you're going to have the same slow-growth, muddle-bad economy that we currently have. If a Republican gets in, and based upon what they're talking about, they're looking to grow the economy, that will help all Americans do better with jobs. So in my opinion, if a Democrat gets in, we're going to have a slow growth economy. It's not going to collapse the economy, but it's going to be the same policies of bad, slow growth, which I don't agree with. If a Republican gets in, we have a potential, I think, to grow the economy more and potentially to do better. So vote wisely and make sure you really educate yourself about the upcoming election, and don't listen to all the media hype on either side. Really do your research. Find out the facts so you know ultimately what could happen to your portfolio and how you should be invested. Folks, I'm just about out of time. Is your portfolio performing the way it should to meet your goals? Are you truly happy with the advice you're receiving? Schedule a review, a consultation with Rezny Wealth Management. Get that needed second opinion. It's time you get back on track. If you're tired of bad advice, conflicts of interest, or your money's not doing what it should, call Rezny Wealth Management. We have offices right here in Florida. Go to reznywealth.com, and I will see you next week.